Hi there, welcome to Alternative Investing. I'm Andrew Bell, here with me, our regular Friday co-host, David Kaufman, President of Westcourt Capital. Great to see you again.
Good to be here as always.
Now, during the show, we will, of course, keep you up to date on any breaking news out of Egypt. Obviously, dramatic turn of events there. On this show, we explore investment concepts outside the traditional realm of stocks and bonds. It's for investors like you who may be sitting on cash, looking for alternative places to put your money. Each week, we tackle a different alternative investment strategy, and we introduce you to analysts and fund managers who specialize in this field. Now, on today's show, we are going to talk about private equity, but first, we got a lot of email over this, and people are still talking about last week's show. We dealt with quantitative investing and with Noah Solomon, and we've been getting a load of questions.
Yeah, I've been getting a lot of questions as well. I mean, most people, of course, would like to know what the formula is.
The black box.
People understand, of course, the concept of the black box, but they want to know what's in it. And the questions that we have today, I think, are a good example of the kind of questions that I've been getting all week long.
And generally, just to summarize, quantum investing is you take a huge number of inputs, massive amounts of data, and construct a strategy.
Yeah, it's big amount of inputs over a long period of time, and those two things together with a proprietary formula help people to pick stocks and also choose when to buy and when to sell.
Here's an email from Vinoth in Waterloo, Ontario. How large is the quant fund community in Canada, and how is it affecting the market?
That's a great question. And first of all, it's unobservable because it's asking how it is that people make decisions behind the scenes. But the short answer really is probably 100%, because even people who would call themselves fundamental analysts are still using math. It's just a question of what kind of math they're using and how broad the spectrum of the data is. And the two ways that quant investing affects the market in big ways is what people trade, determining which securities to buy and sell, and how they trade, which is when and in what quantities. And quantitative analysis actually works in both ways. In terms of affecting the market, that's a really good question. I think that the second part, the how they trade, is where it gets affected the most, because when you see things like high-frequency trading and automated trading, you get things like a flash crash, which are the direct result of the application of quantitative analysts around the world working not with each other, but at the same time.
Pulling the trigger at the same time. Here's an email from Donald. He says, what's an example of one factor that's used in quant analysis? You've got to be able to reveal one thing that's in the black box.
Yeah, so he's saying, don't give me all the formula, just give me part of it. And I actually called Noah to talk to him about this. And really what I ended up putting together was this concept of an analogy to Coca-Cola. If you turn the Coke can around, the ingredients are right there on the can. So the secret isn't the ingredients, just like the secret with quant investing isn't the metrics used. The secret is the formula. It's the ratio of one ingredient to another, when you put one ingredient in versus the other, how you shake it up, how you bottle it. And that is really, that's really the secret sauce, so to speak. So in Noah's case, because he deals with large cap equities, he said, I use similar metrics to everyone else: return on equity, return on assets, price per earnings ratio, debt to equity ratio. These are things we hear about all the time. And the part that we can't distill into one answer in this case is what's one point to look at, because it's really the concept of the very broad analysis that is what lets quant analysis do what it does.
Well, we'll get back to quant investing in the weeks ahead, and thanks for those emails. Alternative investing at bnn.ca is where to send your comments and questions. Let's get into today's show. It's all about private equity. David, what is private equity once again?
First of all, private equity is the purchase of all or part of an equity interest in any business that's not publicly traded. So that part's easy to understand. And the scope of private equity is, of course, quite wide. It can be in any sector or industry, although in Canada, specialists often specialize in areas like oil and gas, of course. The key, as far as a private equity fund is concerned, would be to understand whether they take passive versus active bets or minority versus control. I mean, naturally in the public sphere, when someone buys and sells 100 shares of RIM, they aren't exerting any control. They're betting on a market direction, whether it's long or short, but they can't do anything to affect the value. In private equity, it's possible to do that. You can hook along for a ride with somebody else, or in many cases, you buy a majority or 100% of the shares in a private company, and then you exert control in order to add value, which, of course, increases value in the long run. And private equity funds are typically distributed through, sold to high net worth individuals, family offices, and of course institutional investors. We hear about it all the time, whether it's university endowments, pension funds, or other institutions that will trade enormous amounts of capital and use private equity as a vehicle to do it.
High net worth individuals, how do they typically invest in private equity?
A lot of them own their own business, so they're all in. They don't see it that way, but they're all in into private equity. But if they wanted to have a diversified approach and access to a larger scheme of private equity, they would do it through private equity funds. And the way that that's possible, different funds take different strategies, of course. So you have venture funds. Let's find the next Google and invest in that. You have corporate restructuring funds, which is get under the hood, buy in, add value, and sell. The leverage buyout we've heard about for years, which is where you use the assets of the company you're buying as collateral to borrow the money to buy the company in the first place. Management buyouts usually are LBOs. And distressed situations, which unfortunately we've seen a lot more of post-2008, where some people call that vulture investing. But all it really is buy low, sell high.
And just very quickly, what are the features of private equity funds? What are the main things to look out for?
Okay, so the first is that you pool investors' capital. It could be anywhere from, say, $50 million up to $5 billion. You put it in a pool. You deploy the capital, i.e. you buy private equity stakes in different companies, and that can take up to 5 years. You manage the assets so that when some are ready to be sold, you sell them. Others you have to nurture along. And that happens right up until the end of the fund. And then at the end you exit, which could be 7 to 10 years out. And that exit can take the form of an IPO, sale to a larger fund, or you can actually break up the pieces where the sum of the parts is greater than the whole that you began with. That would sort of be how that fund might work.
And finally, typical fees?
Fees. Basically, we're looking at something like 2 and 20. So a 2% management fee on deployed capital and a 20% performance fee, usually over a hurdle, maybe 6 to 8%. The performance fee goes to the manager, and the 80% of the growth goes to the investors in the fund.
Well, coming up, we're going to continue talking about private equity with a real player in this area. We have Brent Belzberg, Senior Managing Director, TorQuest Partners. He'll tell us about how to invest in everything from infrastructure, such as roads and highways, to manufacturing and financial services, and all through the world of private equity. Stick around. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. Today we are talking about private equity, and we have Brent Belzberg, Senior Managing Partner, TorQuest Partners. Great to have you here.
Thank you very much.
Tell us what you've done in private equity. What's your role?
Well, I'm one of the old guys in the business. There's no doubt about that. I've been doing this for 25 years in Canada.
You've been around. You founded Harriston. That was a formerly TSX-listed private company. You're on the board of CIBC. So you've seen a lot of deals over the years.
Well, when I started, there was really no institutional market for private equity. The only way you could do it was use the public markets, and that's how Onyx was built originally. And subsequently, the business was sold in 2001 after a bid was made for Harriston, and we started a traditional private equity fund in 2001 called TorQuest.
And that's interesting. If you look around, say, 1980, which wasn't that long ago, I was looking yesterday at the Harvard and the Yale Endowment Fund pie charts. 0% private equity. Today,
Right.
it's much more than that. It can be over 25 and a lot more than exposure to public. Can you talk to us, what are the advantages for an institution of a large-scale investment in private equity?
Well, it allows them to use leverage on their balance sheet and therefore get a higher return. It's like all alternative investments, it's seen as a slightly higher risk profile than a traditional equity portfolio. But it provides them with returns and investments in areas that they would otherwise not be able to get.
When you say leverage, just the volatility is potentially more.
That because you use debt, and you use higher levels of debt traditionally in leverage buyouts than you use in traditional public equity vehicles.
When you have a private equity fund, there's the timing of the purchase, management, and sale of the individual portfolio companies, and then there's the fund itself.
Right.
So can you walk us through sort of how those two might compare and when the investors might see capital coming back in a general way?
Sure. Like the skill set of a traditional private equity investor is, first of all, in having institutional relationships so that they can raise the capital. Then beyond that, they have to find and locate transactions that are suitable for their particular investing style. That's harder than just researching a list of public equities that are available and that everybody knows about. So you have to find the transaction from scratch. Then you have to choose which one to invest in and which one to spend your time on. A young man before the session today asked me how many transactions you look at before you do one. Well, it's hundreds before you do one. And then beyond that, you have to be able to choose the right management team to work with. You have to be able to choose the right capital structure to put in and be able to find the appropriate amount of leverage and the right sources of leverage. And then you have to know how to close one of these transactions, actually acquire it, which in itself is a hard thing to do. Then you have to understand strategy and how to build the company, because you generally are not buying it to leave it where it is. You're buying it because you think you can do something with it to make it, if it's not broken, to make it bigger and to add things on. If it has a problem, on how to fix it. And then you have to determine basically when to sell it.
I mean, speaking of exits, tell us a bit more about TorQuest, because you just pulled off an exit. Lowepro, the camera bag company, they're pretty ubiquitous. You just sold that company.
Yeah, we did, but we owned it for 5 years, and we did a lot to it. We bought it when it was a small Canadian entrepreneurial company owned by a German entrepreneur who didn't have a lot of capital. He was brilliant in his designs and brilliant in building a company, but he had no serious capital. So by us providing capital, we were able to build systems, hire the right management teams, expand it in a whole bunch more countries around the world, buy back distributors, develop relationships with Chinese manufacturers, and refinance it. And after 2 years in it, we basically refinanced and took almost all our money out, left him in as a small partner in the transaction. And then 5 years later, it was a time for us to be able to return some money to our investors, so we did that.
That's so interesting, because essentially, of course, you're going long with every purchase. So you're long equity all the time. Mm-hmm. But that doesn't mean that you're hopping on the market risk bandwagon, because you're adding value, right? And how much, from the timing point of view, how much do you have to forecast what the markets are doing versus what your companies are doing?
Well, you are measured on a relative basis. There's no doubt about it. We don't measure ourselves on a relative basis. We look at it on an absolute basis. So generally, funds that invested in certain periods of time have done traditionally better because the markets have carried them. Exit multiples have increased. The growth has been easier than you would expect in other periods of times, and the returns have been higher. And in other periods of time, the returns are generally lower in those funds because you invested at the wrong time in the economic cycle. And one of the things about us is we only invested 30% of our fund over the last 4 or 5 years, kept most of it in cash because we just didn't like the market.
In case our viewers want to be phoning up TorQuest, people would say $150,000 to invest. You generally deal with institutions?
No, we can't take money from individuals. I mean, we could, and there are private equity funds that do that. We just don't do it. Well, I don't think we have any non-institutional investors in our fund, maybe 1 or 2 friends, but other than that.
And when an individual is looking at private equity to fit it into their asset allocation, into the portfolio generally, we talk on the show a lot about the concept of IRR, internal rate of return. You can't just look at simple returns, right, because time matters.
Absolutely.
Private equity funds, by their very nature, because they trade in illiquid investments, take a while to produce capital. Absolutely. And what I'm wondering is, in the end, are you getting adequately compensated not only for the risk that you actually took, but for the time that you locked up your capital? Is there a bump there that rewards private equity investors over public equity investors?
Well, I think so. I mean, in both Harrison and TorQuest 1, we've had over 30% IRRs. So I think those returns outperform traditional equity returns in that period of time. There are times in the cycle that it's tougher, but I think generally they are rewarded appropriately for the risk they take and for doing it. But it's one of the reasons that it doesn't work as easily for the $150,000 investor where liquidity matters, because you don't know when your capital calls are. The funds are generally funded over a period of 5 years, and they're realized over a period of 10 years. So you don't know when you're going to put your money in, and you don't know when you're going to get back.
Speaking of capital calls, we're reading almost weekly about large pension funds reaching into their pocket and making investments internationally. I'm interested in what's the international appetite to invest in private equity in Canada, and then why the Canadian appetite to invest internationally?
Well, the Canadian pension funds are large, and they're big players, and they're smart. And they actually have their own private equity funds internally, and they do a great job of it. They're very, very good at it. They're better than probably almost any institutions in the world in it. And they've got huge international portfolios, and they have people in various countries whom they're investing with or investing on their own, and they've done a great job. And there are Canadian private equity funds that also do international deals. We tend to focus on Canada, but we've done quite a few deals around the world in addition to that. But there are a lot of international people who are starting to think that the Canadian banking system has been so stable that perhaps they should come into Canada and invest. We think in the large size transaction that happens more and more. KKR's investment in Shoppers Drug Mart, Yellow Pages, Bain Capital's acquisition of Bombardier's leisure products business. In the mid-market, it's not so easy because relationships matter a lot more. I always compare, big private equity funds like KKR to Walmart, and little private equity funds like us to corner grocery stores. And the principles are very different, and what you have to do is very different, and the relationships you have to build are very different. So in the middle market, international players have had a tougher time achieving returns in Canada, but in the large size, they've done very well.
We're going to take a break. Coming up, there's lots more still to talk about when it comes to private equity. Next on Alternative Investing, Brent and David look at how pension and endowment funds have been increasing their private equity investments in things like renewable energy. Plus, we'll take a look at publicly traded private equity companies like Onyx, KKR and Blackstone. Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital. Today, of course, we are talking about private equity. We have Brent Belzberg here, senior managing partner at TorQuest Partners. Great to have you here.
Thanks, Lauren.
People look at IPOs, and there's always a lot of razzmatazz. But, is the company almost always going to be overvalued, given that you guys, private equity, have taken a pass on it?
No, not necessarily. Sometimes being public suits a particular company better. The individuals associated with don't want a major partner in and the management teams are happy to have a wide level of investment from a wide source of capital if they know there's going to be significantly more capital needs over the long term. Public capital markets are available to them and they like them, and often companies just don't like the level of leverage, and therefore they're not comfortable doing a transaction with a private equity investor. We always try and sell the advantages of being private,
because
of course.
Life is horribly complicated when you become public.
Absolutely, and it's a big issue for lots of people. First of all, you're measured on a quarterly basis. You're being judged by analysts on a regular basis. People who aren't as actively involved in the business, but from outside are making critique on what you're doing.
Not just on BNN.
That's it. So we think there's lots of advantages to being private. The leverage allows the management teams to get a lot more options than they would get normally in a publicly regulated. The TSX regulates the level of ownership upside that management can get, and option pools and private investments. Those things are not there. You're allowed to invest for the long term, so you can make a capital investment in a plant that for 5 years isn't going to pay off because, the value is there. And you can see an exit. So if you're at a certain age, you're going to realize some value as a management team.
It is. So I was just going to say, say BHP's purchase of Potash Corp. They're thinking almost generations ahead. And it's almost insane having it publicly traded and wobbling around every day.
That's a very big example. Commodity plays generally don't work for private equity businesses because they are not susceptible to high levels of leverage. So you don't see a lot of leverage buyouts in the oil and gas industry, in the mining industry, pulp and paper, areas like that, or even agricultural products. You tend to see them more in industrial companies, service companies, and even some financial service companies.
When an institution decides to take, whether it's a minority or majority stake, though, in a large firm, the fact that they aren't regulated in the public markets doesn't mean, I presume, that you don't insist on internal controls that are similar to the ones that a public company would have to institute.
That's a really good question. Absolutely, that's right. I mean, we have exactly the same governance formats inside our companies as if you're a public. We have audit committees, we have nominating and corporate governance committees, we have all of those things. It isn't that the governance is any different, it's just that you're not in the public eye all the time when you're doing these things. You're doing them for your own purposes. The Sarbanes-Oxley principles are appropriate even for our companies, and we utilize them as much as we can, but they're not regulated from somebody outside. So if we choose to have certain people on the audit committee and they're not financial experts, we can make that choice.
I'm not asking you necessarily to comment on your competitors. You're welcome to, but Onyx, KKR, Blackstone, they're public. So what's the deal there when private equity companies go public?
Well, it is a way of providing liquidity to older partners and firms who are looking for that. It has traditionally not been a source of doing it, but Jerry Schwartz was ahead of everybody else when he did it years ago.
In '87.
That's exactly right. He was prescient in what he did in that area and has done a great job of it.
But part of the point of going to private equity is so that you're not susceptible to these swings in the public markets. And so if a private equity firm is publicly traded, in the end, is the stock of that firm more correlated to the public market or more correlated to the value of the assets that they own?
Well, obviously they reflect the value, but traditionally conglomerates or large holding companies have traded at a discount to net asset value. Whereas when you're measuring against institutional returns, you attempt to mark your companies to market on a quarterly basis to reflect their true net asset value.
Very, very quickly, mark to market. It's always going to be tricky to value private assets.
Very, very, very difficult. You try and use public company comparables, but you also use discounted cash flows, EBITDA multiples, a whole bunch of other ways. And for every company, the analysis is different. And firms like Deloitte's, KPMG, Pricewaterhouse, Ernst & Young have big valuation departments that help you through those processes.
Brent, thanks very much indeed.
Our pleasure. Thank you very much for having me.
Brent Belzberg of TorQuest. I hope you'll come back soon, Brent.
Thanks
it's very interesting. We're out of time on today's show. We will be back next Friday at 11:30 Eastern, 8:30 Pacific with another edition of Alternative Investing. Goodbye from David and me. If you've got a question about alternative investments, email us at alternativeinvesting@bnm.ca. Thanks for watching.